Europe has built one of the most protective economic systems in the world. If you lose your job, get sick, or face financial hardship, the system is designed to catch you. That protection is not accidental. It reflects a deliberate philosophy that economic stability should not depend entirely on individual success or failure. And in many ways, that model works. Across much of Europe, poverty rates are lower, access to healthcare is broader, and income shocks are less devastating than in more market-driven economies. But protection is only one side of the system, because every system is built on trade-offs. To understand the trade-off, you have to look at how the system is structured. European welfare states operate through a high-tax, high-redistribution model. Governments collect a larger share of income and then redistribute it through benefits, public services, and social support. Data from the OECD shows that many European countries have significantly higher tax wedges on labor than the United States. That means a larger portion of additional income earned is taken through taxation. At the same time as income increases, benefits are gradually reduced. So, individuals face two pressures simultaneously: higher taxes and lower support. This creates what economists call an effective marginal tax rate. And in some cases, that rate becomes high enough to influence behavior. Not whether people work, but how much more they are willing to do. Whether they take additional hours, pursue higher-paying roles, or take entrepreneurial risks. Research from the Institute for Fiscal Studies shows that these structures can reduce the incentive to increase earnings at certain income levels. This does not mean people become lazy. That is an oversimplification. It means the system subtly shapes decisions at the margin. And in modern economies, those marginal decisions matter. Now step back and look at the global picture. Economic growth today is no longer driven only by labor participation. It is driven by innovation, capital formation, entrepreneurship, and risk-taking. And this is where the comparison becomes sharper. Because the United States operates a fundamentally different model, the United States model includes lower taxes on income, less redistribution, weaker safety nets, but significantly stronger financial incentives for success, higher potential upside, greater income dispersion, more volatility. And that combination produces something critical. It attracts ambition, not just domestically, but globally. Across decades, the United States has consistently attracted some of the most ambitious, skilled, and risk-oriented individuals in the world. Entrepreneurs, engineers, scientists, investors, people who are not just looking for stability, but for opportunity. Because the system offers something very specific, a higher reward for taking risk. This is not just cultural, it is structural. Capital markets in the United States are deeper, more accessible, and more responsive to high-growth ideas. Venture capital is more developed. Funding is more available. Failure is more tolerated. And the payoff, if successful, is significantly higher. That creates a powerful signal. If you want stability, there are systems that provide it. If you want to build, scale, and maximize upside, the United States remains one of the most attractive environments. Even institutions like the International Monetary Fund have pointed out that long-term growth in Europe is constrained by structural factors, including labor market incentives and slower productivity growth. And this is where the real trade-off becomes visible. The European model reduces downside risk, but it can also reduce the relative reward for exceptional performance, which affects not just individuals, but the overall dynamism of the economy. Because economies do not grow only through stability. They grow through experimentation, failure, and breakthrough success. And those require strong incentives. Now add another layer: demographics. Across much of Europe, populations are aging, which increases the cost of welfare systems. Fewer workers supporting more retirees. That means higher taxes, greater fiscal pressure, and more strain on the system, which reinforces the same cycle. More protection requires more funding. More funding requires higher taxation. Higher taxation affects incentives, and over time, that balance becomes harder to sustain. This is not a failure of the system. It is the natural outcome of its design priorities. The system is optimized for stability, not for maximum dynamism. And that distinction matters, because in a global economy, talent and capital are mobile. They move toward environments that best align with their objectives. Some will choose stability, others will choose opportunity. And that is why the United States continues to attract a disproportionate share of global entrepreneurial talent, while Europe remains stronger in providing social stability. So, the real question is not which system is better. It is what outcome each system is designed to produce. Because protection and reward do not always move in the same direction. And when a system prioritizes one, it inevitably reshapes the other. So the question becomes, how much protection can a system provide before it begins to reduce the incentive to build, to risk, and to grow?